All right. Good afternoon, everyone. Rich Swerbinski with the Mortgage Collaborative here once again for the last week in Mortgage Today, our weekly walk through all the latest news headlines in the mortgage industry, an assessment of the current business climate in our industry. And each week, I'm lucky to be joined by one of our lender members as my co-host. And this week, very pleased to have the president of Go Mortgage, Chad Jampedro. Chad, thanks for joining me.
For sure. Thank you, Rich. Thanks for
And
having me.
absolutely. And just a little level setting, I guess, tell our audience a little bit just about your company size, general model to kind of level set the conversation here.
Size, we're just over 210 employees. We've been in business now. This is 26 years, which is a long time now. We've made the brand shift from GSF Mortgage Corporations to Go Mortgage. And we're still in the process of doing that this year. I think we intended to do it in 2020, but 2020, lots of things happened. So now we're making that shift this year, but the majority of our retail are already on the Go Mortgage brand, and then we're moving over our TPO platform. So and for me, this is 21 years in the mortgage industry, which I started out as an originator with GSF Mortgage. I've been with the company all of those years, right? And believe it or not, way back 20 years ago, I had a full head of black curly hair, and now this, right? So it's taken a toll.
Well, congrats on all the success and growth and the long run at one company. Always great to see that happen. And one of our newer TMC members, I know I've been all over you I tell people when I do that, I don't recruit, we recruit companies, we recruit people though, to a certain degree. And
Yeah.
your guys got a great reputation in the industry and really appreciate you making TMC part of your kind of business strategy for 21 and beyond.
Yeah, we appreciate the partnership for sure, and certainly, we're sometimes tough to nail down, but we want to make sure that anything we're a part of, we can contribute and get value from. So we certainly see that with the group, and happy to be a part of it.
Awesome. All right, so let's get right into it. And as always, encourage interactivity with this program. Anybody that has any questions, comments, thoughts for Chad or I, please feel free to drop them in the chat or the Q&A, and we will voice them aloud and incorporate them into the discussion. And already saw Rob Chrisman on there trying to get me to change my sign, but there's still too much support for that message to change the sign just
Right.
quite yet. So, Chad, let's start by talking mortgage rates. Anybody that's had the news on this week or involved in our industry knows rates are up, bond yields are up. We've seen a flight away from kind of growth in tech stocks and into bond yields. Mortgage rates fuel off that. January was a great month, I think better than most expected for just application activity, purchase activity in general. We've seen rates tick up now, 30-year fixed rate in that 3% range for the first time in about 6 months. How has that impacted, if at all, new applications, purchase activity, refinance activity with your company these last few weeks?
Well, I'll tell you, certainly, that shift, right? We're heading into a new cycle with rates instead of it seemed like we're constantly finding new lows, right? We're going to start to see those rates rise, which could be a good thing, right? I know that my originator friends wouldn't say that, but in watching Jerome Powell speaking today, I mean, there's concerns in the overall economy that the Fed has to deal with, but overall, certainly accommodative to buying treasuries and mortgage backed securities. And think about it this way, it could be much worse than this. But as it relates to the overall market, at least how I see it, is that purchases, they're really undaunted by the change in rates, right? So that demand there is just overwhelming demand. Obviously, there's more of a concern around inventory than anything else. And then, we're not seeing it yet in locks, or maybe in just because you've got those panic locks and the kind of hey, I missed the bottom type scenario. But what you'll start to see is in the early activity, right? So the media helps us quite a bit when you talk about lowest interest rates, right? So CNBC talks about lowest interest rates ever. You can almost correlate that to, looking at your website and activity going up. So, we're going to see that go away a bit. And, depending on what happens here, we may have some short-term relief. There's some some levels that we're looking at the Treasury, and then on the MBS, depending on whether you're on the Fannie side or the Ginnie, that could impact rates, maybe get a little bit of a reprieve to get some of those folks that maybe thought they missed the boat in. But the overall reality is that rates will go up. And, in our business, we to be successful long-term, you got to manage the cycle. So I found myself spending time with originators this week talking through that. And I always tell them the story kind of, when I got into the, industry in 2000, 2001, well, then you had 9/11, and then, rates were much higher than after 9/11, rates down. So customer acquisition changed, right? So I talked to them about, if you ever played a sport, or, if you love, let's say, the Packers, right? We're talking about when your team's up by a lot, right? You can relax a little bit. Competition goes down. It's like, hey, I can enjoy it. We're winning by 4 touchdowns. And then, the next game, that's not going to be the same scenario. Not to say that they didn't earn that 4 touchdown victory. We got to get back out there and compete and manage those cycles. So that's what we're seeing now. And, really good, solid companies, they've been planning for this day. No one can say that they didn't know that this was going to happen.
Yep. You mentioned the inventory issue. It's been a recurring topic of discussion on this show each week as we take the pulse of the industry. I've been, on record, just starting to really get concerned about, what we're seeing with home values, the lingering inventory issue. Noted a couple of times, I'm looking to buy a house myself here in the Cleveland, Ohio market where I'm at. So I'm keeping an eye on things. I mean, homes are just, they're on the market for a couple of days and going for asking to above. So it brings me to the point of new home construction. And one of the reasons that I wanted to have you on as a co-host is Go Mortgage, really, which, unlike a lot of independent mortgage banks, is involved in the new construction lending space. So, clearly demand for more homes to be built in America right now. I don't think anybody would argue that. There's some definite impediments, the 3 L's as we to land, labor, lumber. I would love to just hear your assessment of the new construction market in general, in our industry, and how you see that part of our business kind of playing out these next couple of years.
For sure. Well, listen, we saw opportunity in the new construction space a number of years ago, and really, even then, we could see, if you think through it, the last time I looked, when you look at, household formation since 2006, so this is pre-meltdown, everything went crazy for a few years, right? There's only been 4 years that there were enough units built to meet that new household formation. And when they did meet it, if they exceeded it, it wasn't by much. And every other year, we were underbuilt by significant amounts. So what we're seeing today is really the compounding effect of all of those years of being underbuilt, and then a shift in the sentiment of, okay, moving to cities, maybe a little bit more to the suburbs, because, you don't necessarily have to be next to work now. Work from home has changed things. And I think that that's an element of the pandemic that's here to stay. And now the home's now being looked at as more than just a home space. It's home space, workspace, activity space. So that's changed things. So then all of those years of being underbuilt, that demand continued to grow. We just didn't notice it as much, but we're seeing it certainly on the inventory of homes listed for sale, of existing homes. And then, on the new build side, tremendous demand. I mean, the activities, you could see it in the National Home Builders Association numbers that they shared recently. And you could see that certainly starts are up, but there's going to be some lag, and it comes back to that first day of macroeconomics. We're in, that supply and demand cycle now, and that plays out on the existing home, but it's also playing out in the construction space in and around, materials and labor. Think about when you look at the last survey of home builders, number one there was the price of materials. Then the second concern was the timeline to get materials, and then the third was labor. So, and those are all elements of really just tremendous demand, and then now trying to meet that demand with supply, but that's boiling down on the raw material side.
Absolutely. Yeah. Excellent insight. And you mentioned it. Building permits were up 30% year over year. The last report that came out, that's kind of like the first,
Right.
foreshadowing of new construction when building
Sure.
permits are filed. So that really portends, great construction activity
For
this year.
sure.
And I wonder and worry, with the price of lumber, with the price of land right now,
Right.
does that
Well,
mean, what is
well,
to be the average price of these homes that are built? Does that maybe help our inventory issue, but worsen the affordability issue in America?
yeah, I mean, the affordability part of it, I mean, again, that's, really dovetails into demand, right? So we're seeing it on, certainly on the origination side, for existing homes, especially in this market, we're not seeing the listings come to market as quickly as maybe they have in the past. So when you see that listing, if you really have a driven buyer, they're going over asking, right? So they're driving the price up. Now a bit more inventory maybe in the spring as folks in the typical cycle, that may help a little bit. But on the construction side, if you think about it, right? So last stat that I looked at, roughly 303,000 average home. Most builders, you can have some that maybe in the higher range, but let's say they're in that range, right? So they're in that average range. So the cost of the increase in lumber adds about 24%, right? Or excuse me, 24,000 to that average home price, which is about 7 or 8%, which then kind of correlates to the over asking price. Maybe over asking price is a little less than that, but that's what you're seeing, right? So, if you add that 24,000, to the average build, it's palatable, right? So the demand is a powerful thing at this moment. So, certainly concerns on delivering in the builder space because, they're going to have labor constraints and really just capacity constraints the many mortgage companies experienced just through 2020 and even continuing into now. Just, hey, great that the business is there. How do we get it done, right? How do we actually manufacture it? And it's going to be the same on the builder side. But the good news is that there's a focus on that, and that we're looking for solutions. And certainly there hasn't been much help in the builder space in the way of just kind of previous administration of focus on that. I know that was talked about a little bit in some of the builder circles of maybe the new administration would see things a little differently and help out understanding that new home starts can stimulate the economy in a more purposeful way than just blind spending. So maybe that happens in 2021. We'll see. We'll see.
Would be great to see, and
Right.
it will be interesting to see how this all plays out. And I would love to continue to get your insight, throughout the course of 2021 on this really critical piece to the residential finance industry. So
For sure.
this is the last week in mortgage today. I'm Rich Swerbinski with the Mortgage Collaborative, joined by Chad Jampedro, president of Go Mortgage out of Wisconsin. And let's turn our attention to a more sombering headline. Anytime you see CFPB and hiring spree in the same headline, right? I mean, that's something you don't want to see in our industry, right?
Well, here's what I would say about that is that, I think the notion was that previous administration would certainly, look at regulations differently, but how that plays out in real life is different, right? So I feel like certainly the emphasis may, or maybe we just didn't see as much of it in the headlines, but our company and just about every company I know, and certainly those that are members of the cooperative, their compliance departments did not go away. And in most cases during that period of time, they grew. The time and expense that we put into building, a compliance platform, integrating it into your culture was, took years, right? And it took a lot of investment on behalf of those companies. And in 4 years, they didn't just disappear, right? So certainly you don't like to see that, where it's, the scrutiny is going to be, really, intensified in the mortgage space. But I don't necessarily believe it will completely hit the mortgage space. It certainly could. But I would tell you that as an industry, we've accepted that as the normal, right? Why build something on a house of cards? If you're going to run a good business, you're going to start with compliance, make sure you're doing the right things. I'll tell you that, speaking for our company, compliance did not go away. There was not we didn't de-emphasize compliance because we thought, hey, we could, fudge the rules a little bit. because of, really the tone of the administration. So I think this is, something that we'll take in stride as an industry for sure. We're ready for this. We've been ready for this, and things, in my opinion, didn't change much, really on the execution side, during that 4-year period of time. In fact, our compliance department, much like others, they grew, right? We certainly didn't reduce that staff at all.
Thanks, Chad. And again, to our audience, any questions, comments on anything we're talking about here, from the rate climate to the new construction and inventory parts of our industry, regulatory, please don't hesitate to chime in with that. And I think you're right, Chad. I think that mortgage lenders, because of just, the systematic weeding out of people over the years, we're left with a much
Yeah.
stronger group of leaders like yourself. Technology makes it easier to be compliant too. There's so many
Okay.
great tech tools. Um, but the piece of the regulatory pie that I'm really taking a look at here is the fair lending piece of it. I saw some statistics this week, just in terms of home ownership statistics. The divide between whites and non-whites
Yeah.
continues to broaden in the wrong direction there. And if you kind of read the tea leaves, it feels like a big part of this ramped up CFPB is going to be, at least as it pertains to our industry, centered around fair lending. Taking a look at mortgage lenders, application, HMDA data, how it relates to their lending footprint, looking for mismatches there that would suggest that, they're not offering equal credit opportunities to
Right.
all. What are your thoughts on that? As the, president of an IMB, that's not something you've had to really deal with a lot. Could be something that is
Yeah.
looked at in the years to come. And how do you look at that piece of the industry?
Well, I'll tell you that, certainly that's something that, I think, companies should, have an emphasis on and take seriously, because when you think about, just, lending in general, and, there are, shortcuts to, let's say, limiting your risk, right? So redlining comes in to say, okay, in this area, and then it's going to impact those communities. And in those communities, it could have, an impact on, minorities, those of color that potentially don't have, or think that they don't have, an opportunity. And in a lot of cases, it could play out that way. So, the focus is on turning that into an opportunity, rather than, kind of a punishment if it's not, if it's not, the ratios are not met. But it's something that, in our country as a whole, that, home ownership builds a pride in the community. It builds wealth. There's no question about that. If you look at wealth creation on the real estate side, the statistics are staggering. So we have elements of, our citizenship that have been essentially locked out, and in that lockout, it could be purpose lock, being locked out from just access to financing, or just, real estate in general, or in education, right? It's not understood what is possible. So in and around that education piece, I think certainly there can be an element to it. But, it's one of those things where, we're going to look at fair lending, regression tests, and look for disparate impact, because that's part of our compliance plan. But it's more than that, right? It's more than just your compliance plan and being right with the numbers. What is the right thing to do? And the right thing to do is, educate the entire community, and then make sure that those who, are willing, are certainly qualified, willing, and have access to, mortgage products to own real estate, get that opportunity. So I think that could be looked at as an opportunity, not necessarily something that could be, certainly could be risk to a company for sure, if they are on the wrong side of those numbers. But even in education of those companies, sometimes, that's all it takes for that to make a huge shift in their direction.
Very well said. I've got about 9-10 minutes left on the last week in mortgage today with Go Mortgage President Chad Jampedro. A couple comments in the chat that are very relevant. And I just remember this from my lending days, running lending for a bank just outside Cleveland, in the city that bordered Cleveland, Ohio, and really being challenged to find diverse salespeople, diverse sales staff that could help mine those lending opportunities that, maybe aren't walking in the door, or walking in the branch, but are important to your point, to doing the right thing and, being an active steward in the communities that you lend in. How do you manage that? Has that, and I've been out of that game for now 6 or 7 years, but how is that climate right now in terms of, diverse salespeople and diversifying your staff to help build that culture that you talk about?
It can, in some areas, it can, it could be easy maybe to find more diverse candidates because you have access. They're in close proximity if you're going to bring them, into the office. Let's say it is a brick and mortar and you need them there. Now, I would tell you this, that may change a bit with more of the virtual, work, from home scenario that will allow you to make more of an effort if that's not something, or if you feel like that's not, you're not building a real diverse staff. On the sales side, I think across the board, it's really again an education to our industry and the opportunities that exist here. We talk a little bit sometimes. There's like two conversations going on about our industry. One is kind of with those that were pre meltdown and those post meltdown with all the regs. Well, after all the regs were put in, the new groups, the new generation, they see it only one way, and they see it as a great opportunity. And I believe that if we can again be the voice of that opportunity in communities that again typically not being exposed to it, we can again have an opportunity to recruit those that are willing and meet the criteria into the industry because it's a great industry. Certainly having a diverse staffing group brings, certainly, across the board, just, real opportunities to build your business, really have your business mature and find opportunity that maybe you wouldn't have had opportunity to recognize without someone with a different background, with a different life experience, giving you that insight. I could tell you that for me, growing up, I came from a diverse community, but certainly I was not exposed to let's say every type of individual, every race. So I ask lots of questions, and when I meet someone new that maybe I do not have a shared background, I ask tons of questions. In fact, I tell them, I'm like, I'm embarrassed. I'm about to ask you about 10,000 questions, and some of them are going to be in and around stereotypes, and it's not coming from a place, it's coming from a place of stupidity on my part, but certainly not to offend you, but let's get into it. And by the end of that conversation, it's usually about 15 to 20 minutes, I learn a ton. And by the way, a lot of that can be applied to business too. It helps create an opportunity when you internalize and say, wait a second, we can serve this market, right? So I think again, in and around that, that's an opportunity if companies are seeing it that way. And it doesn't take that much effort, more of an open mind than it is, spending money or making certainly there should be some intentional campaigns to build that, but really having an open mind, I'll tell you that will get us a lot further along than really having such a maybe a planned approach to it.
Thanks, Chad. And got about 5 minutes left. Any questions, comments, keep them coming. Moving our attention from Main Street to Wall Street, the Loan Depot guy who's Anthony
Yeah.
rang the bell this week. And another big mortgage company goes public. Always curious to get the thoughts of our IMB, C-suite on how you view that. Is it like, yay for the IMB community? Is it, oh boy, here they come. They're raising money. They're scaling. I got to protect my house. We've had Rocket, United Wholesale, several others now. How have you just viewed that whole dynamic these last few months?
Well, I'll tell you, I think it's a little bit of, all of those, right? You look at the IMBs and say, wow, it's great to see them go public. There's a strategic approach to that for them, for sure. First, let me say this is that, I'm happy to see any mortgage company be successful. And I say that truly because, I look at, I look at everyone that's outside of our company as a competitor, right? You should do that. But I don't look at that competitor as, hey, I want to tear you down or tear you apart. I look at those folks, especially if you've been in the industry, let's say 5+ years, 10+ years, as brothers and sisters in arms, right? So during the meltdown period of time, you could see there was a website, right? It showed every company going away, right? And, those were people, those were folks that, think about inside of every mortgage company, those relationships that you make in the late nights and all of those things. But as it relates to those larger companies going public, it's strategic. It's certainly good for them. Obviously you could see that, from a stock perspective, it could be a challenge. Our business is cyclical. So the question I have is, first of all, you could see those cycles almost a mile away, right? And say, okay, inflation's up and we see that maybe the Fed stops buying, rates creep up. It's not hard to see that potentially those profit numbers and volume numbers are going to come down. How does the shareholder, how do they stomach that? I know that, in an ownership scenario that I'm in with my partners, we've been doing this a long time. You understand and you plan for your cycles. Shareholders are not typically, willing to ride those cycles out. But I'll tell you, it's always good to see mortgage and mortgage companies on the in the trades or on the front of newspapers, because it's highlighting our industry and bringing some awareness to it. We'll see how it all plays out in the end. These aren't the first to go public, so we'll see. As it rides through a couple of year cycles, really, was it a smart move? Was it not? But as it relates to us competing, we're going to have to compete. As I mentioned, everybody outside of our company is our competitor. Doesn't mean we hate them, right? But it means we're going to go out and compete. We have to bring value. So yes, they're going to scale. There's room in this industry for lots of different business approaches. And we're going to focus on what we could do to bring value to our clients in the markets we serve. We know they're there. We know they're in those markets, but whether they were public or not, or big or small, we got to compete, right? We got to go out. We got to add value. If we focus much higher level than that, I think we could miss it, and then all of a sudden you are wiped out by one of those big guys.
Thanks, Chad. Just a couple minutes left. I want to get your thoughts on just margins in our industry. Obviously, last year was a great year for everybody. Volume was great. Margins were maybe the best they've been, at least in a long time. We all knew there was going to be some margin compression this year. And I'm curious, just to, since rates have gone up a little bit here in February, and we've seen apps trail off a little bit, has that accelerated big time? Has it been more of a gradual? How has, without getting into specifics, you've seen that?
Well, we haven't seen it, really. I mean, you're looking at margin, you're competing, but we haven't seen it, in the margin compression times about 2 years ago, that was, really tight. But, it's starting, and you could see it could go in that direction. So, I've learned from periods of time through the cycles all along. We're modeling out, okay, what happens if you shock your pipeline and knock 25%, you knock 30%, right? What does your expense base look like in that scenario? What about margins? What about a drop in volume and in margins, right? So, looking at those models helps give you, and you can plan out really, and it's not the first time you're covering that data when it actually happens. So you're constantly looking downfield to be proactive about, what's occurring. I'll tell you that, what I would tell a new originator getting into the business, or, a company that's, looking for how to maintain, find a niche, right? So we found construction as a niche, and some other niches in particular communities. That niche in a lot of cases, that one, from a margin, it's not going to be as, compressed. And then it gives you something to really kind of bootstrap to, so that you can ride that niche through kind of a down cycle until you get back to an up cycle. So, you're not battling it out basis point for basis point with all of those folks, those IMBs that you mentioned that just went public, right? So, you got to find a way to kind of get to a little bit more blue ocean, and the niche aspect, but constantly planning ahead and modeling out, what does it look like if, there's a cycle adjustment in margin, an adjustment in volume, adjustment in both, so that, you have a plan in place if you have to make adjustments when it becomes the reality.
Outstanding. Chad, greatly appreciate the outstanding insight and a great conversation. Thank you for joining me today.
Absolutely. I appreciate it. Thank you so much.
And as always, our attendees, those of you joining us live, those of you that will be listening to this after the fact on our YouTube channel or our podcast network, greatly appreciate you making time for this each week. This is the last week in Mortgage Today. Same time, same place, every week, every Tuesday at 2 p.m. Eastern. And until next Tuesday, we'll see you then, and have a great week, everybody. Take care.
Thanks, guys. Take care.